Hi everyone, Donnie Schultz and Brace Home Loans here with your market update. It is Wednesday evening, February 1st. This is going to come out to you early tomorrow morning. It's a great day to look at an update because we have a lot going on. Federal Reserve met today. It is going to hit the news cycles. A lot of buyers feel that when the Federal Reserve meets and they increase their federal funds rate, that it has a negative impact on their mortgage rates. It's not always the case, and right now, the last couple of increases, we've seen that. We've actually seen rates, longer-term rates like mortgages moving lower while the Fed is still increasing. The reason for that is because mortgage rates are tied to longer-term securities. So, they really go off of the 5 to 10-year treasuries because that's how long a 30-year fixed-rate mortgage is anticipated to be open on the market before it's refinanced, paid off. Short-term rates, overnight rates, we are getting to the end of the Fed hike. A lot of analysts feel like today could have been the last one. They have slowed the size of the increases. So today was a 0.25% increase. The Federal Reserve is advising markets that they see at least two more 0.25% increases over the next two meetings, possibly three. Markets feel that today could be the last one. It all has to do with economic reports that are coming out. And there's a case to be made for both sides. We are definitely seeing signs of deflation. Jerome Powell came out today in his press conference and acknowledged that we are seeing prices come down. But market participants were also expecting him to come out and throw cold water on the rallies that we've been seeing in treasuries, the rally we've been seeing in the stock market over the last 45 days. And he did. He came out and he said markets are misevaluating what's going to happen moving forward. The Federal Reserve is probably a little bit more conservative. They want to make sure that all the work they've done over the last year really stamps out inflation. Where markets think that they've done so much damage already to the economy that these reports are going to start coming out very negative, and it's going to force the Federal Reserve to not only pause the hikes but also lower interest rates earlier than what they're advising. So right now, Federal Reserve says, hey, 2-3 more hikes. We're going to hold that terminal rate, that's the peak rate, for as long as we can. They see that they are not, or their outlook says that they're not going to start reducing that rate until at least 2024, where a lot of traders today feel that, hey, today could have been the last hike, and the Federal Reserve might need to start decreasing their rate as early as the summer or the fall. So there are two different views on this. It's really tough to say who's right, who's wrong. It'll probably end up being somewhere in the middle. So as a home buyer today, you want to be cautious. We have definitely seen rates peak, and that's represented in this 10-year Treasury chart here. We peaked back in October, and we've been moving lower. There's always going to be ups and downs. Right now, average 30-year fixed rate is probably around 5.875%. But we are seeing buyers come back into the market. Over the last 3-4 weeks, I personally have definitely seen activity pick up substantially. So we have a lot of buyers coming into the market. We still have an inventory problem. This is going to further create pressure on home prices, specifically in our area on Long Island moving forward. If these rates continue to drop, I think that pressure is only going to increase. The Federal Reserve sees this. So again, I think they're going to try to keep rates from moving substantially lower. And that's why right now, we're definitely advising clients to lock in. Even today's move, we had, there wasn't anything surprising. And yet, markets rallied. Part of that rally could be because of the substantial short positions that have been opened up over the last couple of weeks. Market participants felt that Jerome Powell was going to come out today and, again, throw a lot of cold water on this rally. They thought he was going to come out and his verbiage was going to be aimed to bring markets down, and it was. So, today could be a situation where we saw a classic short squeeze. There's so many short positions. There's a forced rally upwards, and then all those short positions have to close out, or they have to buy to cover and limit their losses. And then you have this kind of artificial increase. That definitely could be what happened today. we'll know in the next day or two. If we open up very red tomorrow and the 10-year Treasury is back up close to 3.5, we'd say today was a short squeeze. Next big step is going to be Friday. So if you look at the economic calendar over here, Friday we have payroll, jobs, unemployment, wages. Those have all been things that the Federal Reserve has pointed out to say that the economy is still strong. And they're not wrong. There are jobs. Wages are increasing. The unemployment rate is very low. Now, there are market participants who say, well, there are citizens who have to go out and take a second job because they can't afford to pay their mortgage. They can't afford to buy groceries. But we are also seeing prices come down on some of those sides. So it's definitely a fluid environment. We are going to be very data dependent. If jobs come out strong on Friday, we will most likely see rates go up an eighth or a quarter. If they come out weak, we might see this rally continue. We might see rates try to push down to 5.5, 5.625. But any way we look at it, we want our buyers to be ready. We want them to be prepared. We want to keep them from having to face the volatility in the market. So if you work with a loan officer or bank that advises clients to float their interest rate, right now is not the environment to do it. You want to be working with a lender that has long-term lock protection. Every one of my clients, 105 days of lock protection. We want to cover the contract, and there's no reason for us not to lock an interest rate in. Most banks will have some type of float-down feature policy. So if rates drop from the time that the loan is locked, if they drop at least 0.25% or more, the buyer should be able to get a lower rate before closing. So really no reason not to protect that interest rate in. Any questions on this? I'm always available. My team's always available. Hope everybody has a great day. Talk to you guys soon.